Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into another episode of the Money Insights Podcast, where we teach you how to invest with benefits. My name is Christian Allen. I'm here with my co-host, Rodney the Pod Zabriskie. Rod, what's up, man?
Hey, I'm doing great.
I'm glad you're doing great. That was a strong hey to start things off. And I felt the energy and I'm ready to bring it because you're ready to bring it. So what do you think of that?
I love it.
Okay, Rod, we're talking about another exciting topic. We're going to talk about life insurance as a wealth creation tool. Okay, so I said that jokingly, but it actually is a topic that I'm quite excited about and passionate about because, Rod, it's so misunderstood, right? Life insurance is one of the most misunderstood financial vehicles that exist. That's why we have like these ongoing debates between what type of insurance makes sense, term and whole life and IUL and whole life and all these different things. And there's like different people in different camps that really feel strongly about it. Here's the deal. Life insurance is a powerful wealth creation tool, and just about every type of life insurance can be a powerful wealth creation tool or wealth protection tool, right? So with that being the case, I'm excited to jump into this. We're going to talk about why life insurance as a wealth creation tool fits so well into our invest with benefits philosophy. Let's jump into it by talking a little bit about let's talk about our two core strategies, Rod, because obviously both of those are two core strategies using life insurance, right? So maybe I'll touch on high level investment optimizer, then you can talk about Capital Avalanche after that. So Sweet. One of the core strategies we use is, we call it the investment optimizer, and it's actually a very simple strategy. We're using high cash value life insurance. Basically, we take life insurance, we maximize the cash value in it, we minimize the cost so that you can then use that as an opportunity fund to go invest. So we're really just leveraging the insurance company's money because one of the unique benefits is we have the ability to borrow against it. Again, the whole key here, and this is really important, this is why I'm laying it out up front, is it's an augmentation tool. It is not the investment. Life insurance in this situation, we're using it as a way to create another level of profitability. In other words, we're using it to create additional return. Simple. Think of it this way. If I was getting 4% without it, maybe I'm getting 5 or 6% with it. Maybe you know what I mean? So the difference is just by simply running my opportunities, like my investment deals through the life insurance policy, through the investment optimizer, we then create that additional return. And for that reason, Rod, it's foundational because everybody invests. And therefore, once I understand the concept, once I understand the strategy and get the math behind it, it just makes sense to run my investments through there first so that I'm always creating that additional layer of opportunity, the additional layer of profitability. What did I miss, Rod?
I think you hit it really well, but maybe I'll repeat one thing just to make it really clear, because even after we've said it, sometimes people don't quite hear it this way. And the idea is that the whole life policy in this context, when we're putting money into it, we're not putting it there to stay. We're not saying I'm putting it here instead of putting it in real estate or my business or something else. We're putting it here first, and then using that as the capital to go out and invest in these other places so that we can create that additional layer of profitability.
Yeah, well said. I just thought of something that I want to back up and do for a second. I want to back up and talk a little bit about some of the characteristics of permanent life insurance. Okay. Just because I think it's important, maybe even critical to understand those in conjunction, again, with invest with benefits philosophy, and it'll help to better understand both the Capital Avalanche that you're going to talk about and specifically why the investment optimizer is powerful. We've talked about kind of the main reason, right? Generating an additional return, but there's some characteristics inside life insurance that are unique that just naturally make things a little bit better than what we would get otherwise. Okay, so first and foremost, The reason that people generally buy life insurance is for a death benefit, right? That's the starting point.
Yep.
And life insurance has a tax-free death benefit that goes to our heirs. Like, again, when we're talking about estate maximization, one of our 6 key benefits, we want to make sure that we're maximizing our estate by passing along assets that are effective to pass along. Life insurance is, if not the most effective, well, it probably is. It just probably is the most effective, the most seamless asset that I can pass from one generation to the next, because obviously it's just cash, tax-free money that's totally liquid that people can go and use for whatever reason they need to.
Yep.
So from that standpoint, hugely powerful. I don't want to lose the importance of what it does. Okay. And not only from an estate maximization standpoint, but just from a protection standpoint.
Yeah.
Right. So now what we're doing is we're using the investment optimizer, we're creating additional return, but meanwhile, we're also protecting our family, our wealth, by making sure that our plan is fulfilled regardless of whether we die prematurely, right? That's kind of a funny thing, prematurely. What does that even mean, right? But if we die before we're hoping to, we expect to, right?
Yep.
If that happens, most of us care enough about our families, our businesses, people, like we want our money to go to the right places.
Yeah.
And therefore, life insurance is a powerful tool for that. So for that reason, I don't want to lose that component. A couple other things that I think are important. Life insurance has built-in tax benefits, right? The cash value is tax favored with the ability to create tax-free income, which just means when I put money into my policy, it has already been taxed, right? So it's kind of like a Roth IRA in that standpoint. Put the money in, it's already been taxed. It has the ability to grow. And because of the way that we're going to pull it out, we're going to talk about that in a minute, we're going to pull it out using loans. We now have the ability to pull it out without ever having to pay income taxes. So from that standpoint, it can be really powerful. So I talked about protection, talked about taxes, liquidity. It's super important from a liquidity standpoint. Even if I'm not using it as an investment or as an opportunity fund, it can be really useful to have as a place where, I'm just generating a, 4, 5, 6% potential return inside my policy as it's sitting there, liquid money. I don't have to be concerned about it being eaten away by inflation when money's sitting on the sideline or if it's emergency or whatever. So liquidity is a massive aspect of why life insurance ends up being a really powerful asset to use for wealth creation. What am I missing, Rod?
Yeah, I'm glad you're running through this, because often when we describe the investment optimizer, we just get that blank stare or even the outright question, well, gosh, why life insurance as the vehicle? and you're answering all of the question as to why. It's not that we said, hey, we want to make that life insurance do these things. It's that it already has that built in. The government, the IRS, decided that it should have these tax benefits. That's already built in. The fact that the cash sits there and grows on a very consistent basis, especially inside of the whole life policy way you were describing for the investment optimizer, guaranteed interest plus a dividend. And again, so it just grows in a very consistent and meaningful way when compared with savings accounts or money market accounts. And so we're just bringing the pieces together and building it in a way so that we can create that additional layer of profitability that you described for the investment optimizer.
Well, and it's amplifying everything else we're doing, right?
Yep.
It allows us to multi-purpose money and amplify all of our investments. And so therefore, it's like rising the tide across the board.
Yep.
So for us, life insurance is very much a foundational asset that we can then use to be more effective in the alternative investment space. Now, I say that it's more effective in any space, right? Even if you're in the traditional space, we can show a clear path to why owning life insurance is a better way to produce income in retirement even. So regardless of what path you're on, life insurance is just an incredible tool. The key is that you have to understand how it works and how to use it. And once that happens, once it clicks in, it just becomes one of those things that people want more and more of, because again, they're looking at it and saying, this now makes this more effective. This makes this more effective. It's really an incredible foundational asset. So the investment optimizer, while its focus is on enhancing a return, life insurance just has, as a whole, some really powerful benefits. Okay, that said, Rod, talk a little bit about the second strategy that we commonly use in conjunction with life insurance. And I should say, before I turn this over to you, like, there's a lot of different strategies that we can use, whether it's, estate planning and business planning. Like, there's several different things. These are just the kind of two most common things that we see that just make sense for people, because we're solving a couple of the most common issues. One, we're solving the ability to, or the opportunity fund. And then number two, we're solving for a really powerful way to create tax-free income. So that being the case, Rod, talk about the Capital Avalanche.
Okay, yeah. So with the Capital Avalanche, what we're doing is we're taking this. We've described the cash value. Well, that's basically an asset, right? It's there. It's growing on a very consistent basis, and we want to make it so that the growth, the increase that we're seeing on that asset is amplified. Well, how do we do that? You may often hear us talk about this concept of leverage. Conservative leverage, when combined with a growing asset, can make it so that our return off of that asset is bigger than it would be if we didn't use the leverage. So in this case, we've put some money into the policy to get it started. Now we have cash value. Essentially, what we're going to do is set that up as a line of credit using the cash value as collateral. We tap into that line of credit and use that money to put more money into the policy, build the asset bigger. And when we build the asset bigger, the line of credit gets bigger. Well, guess what the next year we're going to do is to repeat that. Take another loan against line of credit, put more money in the asset gets bigger, line of credit gets bigger, et cetera. We just keep moving forward, continuing to build on this asset, which the way we've described it is that we're going to produce a 5-6% consistent return inside of the asset. But because we're adding that leverage piece, when I measure the return off of the initial kind of seed money that I put in, I'm actually able to create a double-digit return that's tax-free. So think about it, 12, 13, 14% of an IRR for me, tax-free. Well, that's the equivalent of 17, 18, 19%, depending on my tax bracket. So now what we've done is we've taken these core principles of what we can get, what we can expect from a life insurance policy, and we've added leverage to that to amplify the return, so that in this case, it kind of does become the investment. Like, it's self-contained is what I mean. We're not reaching out and doing anything with anything else. It's all happening inside of the policy. And to what end? Because in the future, I want to be able to retire. I want to have be able to create some consistent income. And so this creates tax-free income in the future that, again, because of the leverage piece, just produces a lot more income than it would if it was only my own money that had gone into the plan.
Yeah. And I'm genuinely convinced, based on, being in this industry for the last 20 years almost, that it's the most powerful income producing vehicle that's available. Like, I just really believe that.
Okay. So now this is where we become heretics in some people's eyes, because inside of the Capital Avalanche strategy, in addition to using whole life, which we've described in conjunction with the investment optimizer, we're also using what's called index universal life.
Oh boy, Rod.
I know.
Don't do that.
Crazy, right?
Don't do that.
Well, let's talk about the difference between the two. We talked about in whole life, we have the guaranteed interest growth plus a dividend. That's how the cash value grows over time. Index universal life, or IUL, brings with it the same benefits we talked about earlier in terms of the tax benefits, in terms of you have that cash value, it's an asset, in terms of the asset protection, all these different things. Now what happens is that the cash value, it's growing based on a different set of parameters. And specifically what's happening is it's linked to a market index, most commonly the S&P 500. So we'll use that as our example. If I have my cash value there, in years where the S&P 500 grows, then my account gets credited an interest rate that's linked to what happened with the S&P. In years where the S&P loses value, I don't participate in those losses. I just don't earn any interest on my cash value for that year. So what does that mean? That means in the long run, I have more upside opportunity to grow my cash value as compared with the whole life. That's what we like about it. However, there will be years where the market was down. And again, gratefully, I didn't participate in those losses, but I also didn't earn any interest in that year. And so by combining and having both whole life and IUL, we have years where if I'm not earning interest on the IUL, I know I am at least earning it on the whole life. So it's like the balance between the two, taking advantage of their strengths while they balance each other against their weaknesses. So the point is, by using them together, then it just creates it de-risks it, so to speak. Let me try it again. It de-risks it, so to speak, but also providing for this dynamic income that we can produce in the future.
Okay, Rod. So I don't want to get too far into the weeds on this, but maybe just a little bit. So one of as we went through the benefits of life insurance, we haven't dug into the borrowing element. Okay. So I want to get into that so that people understand kind of where we're coming from. So here's the thing: borrow. When we say borrow, we think pay back, right? Like that's how it works. When I borrow money for a house, I have to pay it back. When I borrow anything, usually the idea is that borrowing means I pay it back. Okay, good news. We are going to pay this back, but not in the way that we typically think about it. So here's the deal. One of the really cool benefits of life insurance is that we have a contractual opportunity to utilize the life insurance company's cash value. So when we put money into the policy and we want to borrow against it, we're quite literally taking from a different stack of money. Our money stays in the policy, continues to grow and compound and do what it does. Simultaneously, now we have the opportunity to go and pull money from the general account of the insurance company. We borrow it. So we're, again, quite literally borrowing. And this is important because if you think about the tax element, so think about like a line of credit. If I take a line of credit from my house and I use that money, there's no tax implication because it's not income, it's borrowed money, right? Similarly, in life insurance, you have the same ability to use that just like that as a line of credit. Now it's my cash value acting as collateral, but the benefit then is now that money is going to continue to grow and I'm out there investing in anything and everything that I want to. So Rod, is there anything else about like the mechanics or the benefits of the loan provision that I didn't hit on?
We often get asked, well, how do I, or who determines the payback of the loan, or what is it, a 10-year loan? Is it a 20-year loan or whatever? Well, because of the way you just described that, the cash value is acting as collateral for the loan, and that account is sitting there with the insurance company. When I loan against it, the insurance company is like, well, we're going to charge you interest on this, but we don't care how you pay it back. Your collateral is sitting here with us anyway. Whether you never pay it back at all is completely up to you, because the collateral is sitting here right with us. So what that does is it gives us just a lot of freedom. And essentially what you want to do is you take the loan, you go out and invest with that. That creates some sort of return or cash flow coming back. Makes sense to flow all that back to technically pay down the loan. But the way I think of it strategically is that I'm replenishing the opportunity fund because I'm going to take another loan later and go back and invest in something else. Right.
And by the way, that does feel better, right? If I just think of it in terms of like, nobody likes to pay down a loan, but we certainly love to build up an account or build up a cash value that we can then go use to loan. And that's like, to your point, that's exactly what you're doing. You would be doing it anyway. You're just now doing it inside this interest-bearing account with all of the other benefits that we keep talking about.
Absolutely. And so similarly, now let's talk about the impact of that on the Capital Avalanche, because we described using loans to keep putting money into the policy. And in this case, we might use the insurance company's line of credit. We also might go out and use a bank line of credit, just depending on which one's going to give me better interest rates. But the fact is the same. Cash value stays there. It's collateralizing that loan. And in this case, I have this increasing growth inside of my account. And the loan, this line of credit out here, it's charging me interest, but they allow me to capitalize that interest. So essentially what we're doing is we're just creating an arbitrage between average growth in the account versus the interest that's accruing on the loan. And historically, we would see that be more than 2%. In our projections, we use 2% because that would be it's a conservative number to use. But the point is, when you spread that out over a long period of time, it's okay, on average, how much growth did I have in my account compared to the interest that I had accruing on my loan? We refer to that as the spread. That's what's creating that arbitrage, which again amplifies or increases the amount of income that I'm going to be able to take later in retirement.
Yeah, and it's well, again, you're utilizing leverage, right? And anytime you're utilizing leverage, especially, I mean, particularly if you're doing it the right way, you're being conservative and thoughtful in it.
Mm-hmm.
It now gives you an opportunity to create, in this case, create income, or it could be, you could be using the Capital Avalanche as an estate maximization tool, but however you're using it, having that extra leverage come into play makes it hugely impactful. One of the points that we haven't hit on, Rod, is how in the world do I pay back a loan from the insurance company? And if I'm like in the Capital Avalanche, we're talking about using it for income, but then in the other breath, we're talking about taking loans. Can you do me a favor, Rod, and clarify the how we're using loans and why we're using loans and how that money gets paid back?
Yeah. So with our line of credit, again, the cash value is acting as collateral, creates this line of credit. We tap into line of credit and we use that money to go build the asset, right? So it's just this cycle of funds from the line of credit to build the asset. And then that arbitrage that I mentioned, on average, creating more growth in the asset versus the interest accruing on the loan, so that in the long run, we're not building it to where you're making payments towards that loan. Even the interest, we're letting just capitalize onto the loan, again, because of that spread concept. And then ultimately, eventually, what's going to happen is when I pass away, there's this tax-free death benefit that pays out. And the first thing that's going to do is pay off that loan. And then the rest, whatever's left over, that's what goes to my heirs, income tax-free. So because it's life insurance, it has this kind of self-fulfilling piece that's just naturally built into it, so that when I die, it gets paid off and everyone's happy.
So, and because death benefits are tax-free, therefore, as long as the policy is enforced, it becomes, because to your point, the death benefit is going to go pay off whatever loan is there in the policy, and the rest is going to go to your heirs, like you said. So it's really, really powerful from that standpoint. And again, it's important to kind of realize that there's a different jargon that we kind of have to use around life insurance. When we're talking about loans, while they are getting paid off, they're getting paid off through a death benefit coming in and fulfilling the plan. They're not getting paid off, at least not in the Capital Avalanche, where we're taking income. They're not getting paid by us actually going and putting more cash into it.
Yep.
Okay, Rod, what have we missed? What haven't we hit on? The one thing I know we want to touch on is give a real life success story, somebody that we know. And by the way, we have a whole bunch of them. Mm-hmm. So it's hard to choose just one. But aside from that, Rod, is there anything else that you want to hit on before we throw out success story?
Maybe one thing I would like to throw out, and that is just the way that the strategies we're describing build into an overall investment portfolio. So again, we've had the focus of this conversation has been around the life insurance, and maybe it's really obvious on the investment optimizer side because we're using loans to go out and invest in something and create value outside. But even with the Capital Avalanche, when we're working with people to set these up and use it and build toward this future income in retirement, in this case too, it's not a standalone. It's not a catch-all that someone's saying, "Hey, this is taking care of all of my income needs in retirement." It's built in with I'm going to use the word diversified and then clarify, with a well-diversified portfolio of investments that have different risk profiles, that have different benefits that they can bring to me, that working together kind of give me all the things that I want. And I want to clarify my use of the word well-diversified portfolio, because usually when we hear that, it's a stockbroker talking about, oh, we need to have a variety of different stocks and different classes and different payouts and ways that we're doing that. But to me, a stock portfolio is only one class of investment. I need to be well diversified in a whole bunch of different classes of investments. And so we often talk about the whole kind of alternative investment world, real estate, businesses, funds, precious metals, all these different things. And in the context of what we're talking about here with the investment optimizer and Capital Avalanche, that becomes a part of that well-diversified portfolio of alternative assets that are creating these benefits that we want.
Okay, so just to create a pathway for people, when you think about how these two strategies and how we're using them, so we've got the life insurance for the investment optimizer, which again is just simply an opportunity fund where we earn more interest than we would somewhere else, with several other additional benefits, which we've hit on. So step one then is that we end up creating this investment optimizer, and then our path is that we go out and invest. Similarly, the Capital Avalanche ends up being one element of it. And so the reason I point that out is because this isn't like hey, I just do 2 life insurance investments and I'm home free. It's very much, it's a lot more broad than that, right? Because the investment optimizer side opens us up to anything and everything that I can invest in, particularly, again, we love the alternative space for a lot of reasons, but the key then is to borrow against the money that I have there and go out and invest it. And I can do it in a ton of different places, which makes a huge difference. And to your point, it is not just different. I guess classes is probably the best word. I like that you said the word classes. Maybe that's, I'm trying to find a better way to delineate, but the reality is to your point, mutual funds, which is the most common way that we see people invest, is only one methodology to invest. And there's obviously a lot of other methodologies, but people oftentimes get stuck, especially if you're in the traditional world, with doing just that. And so this gives you a pathway to do more. Now, the next step then is Capital Avalanche ends up being an augmentation tool to create additional cash flow, particularly in retirement. Okay, Rod, let's talk about a real life story. Let's call this person, wait for it, Rod, Chris Larson. That's right. I used his real name. So our man, Chris Larson, talk a little bit about Chris Larson's path. And he's shared this with us, obviously, several times. He's talked about it on the podcast, but I love Chris Larson's viewpoint on life insurance specifically and how he's utilized it as a wealth creation tool.
Yeah, well, he has a good reason to have a positive view of life insurance to begin with, because he talks about his story of his dad passing away and how life insurance became a big piece of that. I don't know, his link to him, his legacy. And so to begin with, he was very positive on the idea. And then as he got into his kind of working stage, he was working as a W-2 employee, but he had this dream of getting to a place where he no longer needed the W-2 income. He could create enough passive income to replace that. And so he started investing in real estate and did a really good job with that. But there was an inefficiency that he noticed in his real estate investing, and that is using a bank account as the opportunity fund, or the place where he's flowing all of his cash in and out of his deals, just felt super inefficient for him. But then he discovered the investment optimizer strategy, started a whole life policy, and started flowing his money through that. So as he's on this journey of going from this W-2 employee to a place where he's creating enough cash flow, passive income, so that he can walk away from his W-2 job, he's now using the investment optimizer as an additional piece to help him get there. And so he did that. So a few years ago, he was able to create enough cash flow. He walked away from his W-2 job. And what's interesting to have watched since then is you know how often in business they talk about that hockey stick? You work and you grind and you see a little bit of growth, but then you hit like this pivotal point where all of a sudden your trajectory the slope goes steep really quickly. And that's basically what I've watched happen with him is once he was able to walk away from the W-2 job and he is focusing more on his investments and building his own business, et cetera, then he's seen a dramatic change in the trajectory of his wealth building. And as a result, the money he's flowing through the policy. So he's started up additional policies. He has more monies flowing through his investment optimizer strategy than he was before, which makes sense, right? As the snowball grows, then also his ability and really the need for that augmentation tool gets bigger as well. And so he's flowing more money through that. So bringing him kind of to today, he's still, on that path. He's still growing. He's still that snowball is getting bigger. But a very key piece of that continues to be that investment optimizer policy.
Okay, Rod, it gets even better than that with Chris. You want to know why? Because Chris takes it another step further. He actually teaches people to utilize the same philosophies, strategies, techniques that he used to get to where he's at to help other people. My point here is to suggest that he teaches other people how to use the investment optimizer as a tool for wealth creation because he's actually done it. He believes that he's seen it in action. And of course, to your point, he went in knowing that not only does life insurance have this death benefit that's really impactful if something happens to me, it's just creating these multitude of benefits across really every phase of my financial life. So if you don't know life insurance, obviously if you're listening to us, you probably know life insurance and value it. But I just can't emphasize enough how powerful it is as the foundational asset that it just allows us to do things that we wouldn't be able to do if we weren't using it. Okay, Rod. So what are your key takeaways from our conversation?
The key takeaways are that life insurance just brings with it a package of benefits that we can't find anywhere else. And because of that, when we plug it into the things that we're doing, and I'll emphasize this again, it doesn't change the fact that people are out investing in their businesses and real estate and all these other things. It just changes the way that they do it. It makes it more efficient, creates more return. And then when adding the Capital Avalanche, an additional kind of asset class with leverage that builds towards this wealth creation and future income. So it's that unique package that allows us to do what we're describing here.
You know what I like to say, Rod? If you're going to invest, make sure you invest with benefits, and utilizing life insurance as a foundational asset is absolutely a great way to do that. Okay, thanks for hanging out with us, and we'll see you next week.
Thank you for listening to the Money Insights podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.